Hello, I'm Katrina M. Craft, and you've just tuned into the Craft More Cash podcast, where finance meets innovation and strategy becomes reality. With over 2 decades navigating the twists and turns of accounting, tax, and business strategy, I've had the incredible opportunity to work with startups and Fortune 500 companies alike, crafting pathways for businesses to grow and thrive. I've tailored my expertise to serve the unique needs of industries ranging from real estate to creators to marketing and beyond. I'm on a mission to equip individuals with the financial savvy they need to succeed. Through my Wealth Intelligence course, I'm all about breaking down complex concepts into actionable strategies for business owners. So buckle up and let's dive into the world of financial success, innovative strategies, and the stories that make us all want to keep pushing forward.
Let's talk about selecting the right structure for your business. There are structures in your business, and I know a lot of people love saying, I'm an LLC, I'm an LLC. And when they come to me, I say, well, how are you taxed? Because a lot of people are not aware that an LLC is recognized at the state level, but it's not recognized at the federal level as a taxable type of entity. An LLC decides, or it can decide, how it wants to be taxed. It could be taxed as a sole proprietorship. That means if you set up the business and it's just one individual, it's going to automatically default to sole proprietorship. If you set up an LLC and you have more than one member, a member is like an owner. That's the word that you would use for an owner of an LLC. If you have more than one member, then it will default to partnership. But you may say, I don't want to be that. I don't want to be that type of entity. Once you have a tax strategy, you're going to be consulted on what would be the best entity for you, your goals, your business, your industry. We're going to look at electing to be taxed as an S Corp. An LLC can be taxed as an X Corp. An LLC can be taxed as a C Corp. Although you will say, I'm an LLC, you need to know how you're going to be taxed. That's important. Let's look at the C Corp. An overview of the C Corp. That is a separate entity. It does not flow to your individual tax return. Right now, the C Corp rates, when 2018 to 2026, it is determining that a C Corp pays 21% tax, a flat tax rate. No matter how much money you make in your C Corp as a profit, you have a 21% tax. That is new. Also, an S Corp. An S Corp flows to your individual tax return. You get a K1, which will indicate your profits or losses from your S Corp, and it has its own tax return, which is the 1120S. That K1 is similar to a 1099, where it tells you your profits, but it also could tell you your losses, and that gets reported on your individual tax return. A partnership, it has its own tax return, a 1065. It also gives you a K1 to show the profits and losses, and that will get reported on your individual tax return. And then a sole proprietorship, that is a Schedule C on your individual tax return. It's going to show your profits and loss. Sole proprietorship is the easiest one to maintain because it does not have a separate tax return. But I highly recommend that all entities, you have a separate bank account and you do not commingle your money. When I say commingle, you have personal expenses and you have business expenses. Even if you have multiple businesses, you need to have a separate bank account for each business. And if that business is, say, a beauty shop, then I'm seeing that there are cigars getting bought in the beauty shop. I'm going to ask, what is that for? But then I may find out that there's another business that is actually a cigar lounge. Those expenses should be separated, because if the IRS were to see those type of expenses in your account, if you're audited, it could be a big red flag and a cause for them to try to dig deeper and find out What other type of expenses you may be taking that you should not. So although you may have multiple businesses, keep the business expenses related to that business in that particular bank account. If you have a credit card, get a business credit card, or you use your business debit card, or if you have the business PayPal account, separate those things. Don't commingle the money, because what happens is if you are audited, then the IRS has a reason to open all of those accounts and look at them, because you are commingling your money. Also, I do like to recommend that if you don't get a business account, like if you can't get a business credit card at this point, you can still get a personal credit card, but just don't commingle. Just say this personal card is only used for business. The reason that's important is because if you do end up having interest, if you don't pay your credit card off at the end of the year, that interest is a deduction. It's only a deduction though if it's all business expenses. If you're commingling that credit card, that negates any interest deduction that you could have taken. That's why it is important to not commingle, keep all your business expenses separately. Oftentimes, I do have clients that say, well, I don't have any money in my business account, so I just use my personal account, or I just use my personal credit card. Please stop doing that. Don't do that anymore. What you should do is you should move your money as a loan or an investment into your business account. So from your personal account, move it to your business account and then spend the money. Because a lot of times, if you're using your personal account, you may miss those deductions when the bookkeeper is, hopefully, someone is keeping track of your books. When the bookkeeper or you are actually recording all of your expenses, you may miss, when you're looking at your business accounts, you may miss that you actually have other business expenses, but you paid for them personally. So that's why it's better to move the money from your personal and then move it to your business accounts and use it that way. Let's talk a little bit more about the C Corp, the S Corp, the partnership, and the sole proprietorship. On the S Corp, you do pay yourself a salary. So as the owner, you should pay yourself a salary. A C Corp, you can also have wages where you're paying yourself salary. Partnerships, you have guaranteed payments. That is not a salary. So it's not like you have W-2 wages where taxes come out. As a partnership, you have guaranteed payments, which are reported differently. And then the sole proprietorship, the same. You can take draws from your account. There's different benefits of having a sole proprietorship, partnership, S Corp or C Corp. If you're hiring spouses and you're hiring your children, there's different reasons why you may want to do different types of entity structures. So that's another important part to look at. And when we talked about retirement, if you have your spouse or children that are in the business, if they're of age and they can have some type of retirement accounts, we really need to look at what's the best entity to hire them so they can also maximize their retirement, and you have a deduction in your business. So the IRS is funding also your other family members and their retirement accounts. So that's just a little bit about business. This week, we were talking about more advanced strategies. Also, we do like to plan ahead. So I want you to look at tax brackets and understand that the tax bracket is a blended rate. 10% would be the first $10,276 if you're single. And then you can look where you are if you're joint, head of household, married separately. And what happens is it's blended. If you made $539,901, the whole amount would not be taxed at 37%. There's a blended rate until you get to the 539, depending on these percentages and the amount of money you've made within that bracket. What's important to know is when you're looking at your tax brackets, $5,000 could allow you to now have to pay additional tax at a different rate. That's why it's important to look at your business return and your individual return in conjunction, because there may be a situation where you don't need, like when we talked about, do you need a deduction? You may not need a deduction this year, because it could, if you take the deduction, It could throw you in a lower tax bracket, but you know next year you're going to have a big gain and you need that deduction and you want to stay below a certain threshold. That's why it's important to really have a tax strategy to look at the difference between, if I make this decision in my business, how will it impact my individual tax brackets and the individual deductions that I can take on my 1040, which is your individual tax return. So where do I go from here? Consultation, looking at where are you, having a consultation to say, are you a good fit for what we do? We work specifically with companies that are consultants, online businesses, digital marketers, entertainment and medical type businesses, and professional services. Again, I want to emphasize that if you are in a certain industry, look for an accountant, CPA, tax preparer, financial advisor that understands those industries. I don't work in restaurants because it's so specific that you need to understand restaurant accounting. I don't work in construction. You need to understand construction and cost of goods and, bidding. Find someone that specifically knows your industry. Then we develop customized tax plans. So after we have a consultation and we know where your goals are, where are you now? We look at, okay, where have you been in the last 3 years? We develop a customized tax plan and a map to help you get to where you want to go. Also, if you're not aware, you can go back 3 years and amend your tax return and get a refund. I have a client now, new person came to me and there's some missed deductions. We're going to amend the tax return and they're probably going to get another $4,000 back. You can go back 3 years, look at missed deductions and amend your tax return. So after we do the customized plan where we go back, we look at the 3 years and then we go forward. We want to be proactive. We implement that. Because I can give you a plan, but if you don't know how to implement it, then you won't save the money. Just like we talked about on the home office, there was different ways to do the internet. If you don't realize that you need to do it a certain way, you could lose that deduction. So that's why it's important that we do implement. And I want to just wrap it all up. Really, when we look at tax savings and customized tax planning, we're looking at timing. Like, what is the best time? When we talked about, is it best to deduct it this year or next year, depending on what's happening in your business and your personal life? We look at shifting. So shifting money from you to maybe a family member. That could be a child who would be in a lower tax bracket. Then we consider the tax code. The tax code is so important because the tax code is going to allow you to take deductions and it really is going to benefit your bottom line. And then we also look at products. It may be insurance products. We talked about the retirement products. We're going to look at, wills, estates. We look at all of that to make sure that you are in a great tax planning roadmap to get to your goals. What we do is called the Craft Money Map. It's tax planning. And it really helps you maximize your money so that you can protect your assets, you plan for retirement, and you have an estate to leave to generations. So knowing what you can legally utilize to reduce your tax burden, we're deciding and helping you decide what's the best entity structure. And then we're talking about how to protect your assets. And we work with a team of other professionals. So we use estate attorneys and trust attorneys. And we also really welcome working with, if you have a financial planner, to help you invest and make those decisions, because a lot of those decisions impact your tax return. So we really need to work together. Then we equip you with a plan. It's usually like a 40-page plan, but we're not going to leave you hanging. We're going to help you implement those areas that we're recommending to make sure that you really achieve the wealth that you're desiring. And we have research and we document the strategy. So they are legal and ethical, but we are going to maximize. Also, some of the strategies we may say, okay, do you want to take on this risk? So say, for instance, you had a junk yard and you wanted to deduct your dog. Some people may say, no, I don't want to have the IRS to even question me about that. But some people like, yes, I want to take that risk. So we do the research and we're going to say this could be a risky strategy, or we feel like this is just low risk, and you can make the decision on what you want to do. Again, the 5-step roadmap: we discover, we evaluate, we strategize with you, we execute it, help you, implement, we review. So did you get to where you want to go? And we also know that things happen. So just because we make a plan today, it could change. So we recalibrate and we adjust so you get to your destination. All right. So I really appreciate you. I hope that you have learned something. And now I'm going to look at some of the questions. Angela, do you want me just to read the question and then answer, or how are we doing the questions?
I can read the question for you and you can just answer the question. The first one is, can you give me more information on self-direct?
The self-directed IRA? Yeah, so there are different companies that work with self-direct IRA. All financial companies will not do that. There are several that do work with. I know Pensco is one, and I think SunTrust is another one. But if you look self-directed IRA, you can find companies that do it. And you definitely need to work with someone that understands the self-dealing, because if you were to buy some real estate and you're heavily involved and you do a self-deal, then that could disqualify all your tax savings that you would have. So yeah, I would definitely say do some research on that. There are companies that definitely can help you with setting up your self-directed IRA.
The second question is, if I have a DBA, should my DBA have its own checking account?
Absolutely. If you have a business and you have a doing business as, that's DBA, doing business as, then do not commingle that business with your personal. It's just easier when you're doing your accounting, because if someone were to come to me and it's mixed with their personal return, that is so hard to try to break away what's business and personal. And it would take more money for someone to help you and to make those decisions. And it's going to take a lot of your time, because then you would have to sit down with that person and say, this is business, this is personal. But if you just have a separate account that only has all of your business expenses, that's going to be the best way to handle your books. Also, if you want more information, I do post weekly tax wealth tips. You can go to CatrinaMCraft.com and sign up there. I have information, and Katrina M. Craft on Instagram, Facebook, Twitter, and YouTube. And I'm working on just continuing to provide education for business owners. All right. Well, I appreciate everyone again. I just love doing this. I want to do more. Just continue sharing. If you know anyone else that's a business owner that you feel like could really be impacted by some of this information, just share. Like if you sign up for the emails, just share with others. And I really appreciate you all.
Okay. Thank you so much, Katrina, for all your knowledge and information that you gave us. Greatly appreciate it. Thank you.
Thank you. Bye.